My next guest is a stock guy, and he thinks this correction is over. Andrew Slimmon is Senior Portfolio Manager at Morgan Stanley Investment Management. The market today, Andrew, kind of behaving like it is. So what tells you that the skies may be clearing?
Well, just to be clear, I think it's going to be a subpar year for equities, but I think we've put in a tradable short-term low. A few reasons. Number one is the VIX hit that panic 25 and it's dropping. I see it's down yet today. Financials were leaders going in. They actually outperformed in the downturn, and they're leading coming out. That doesn't happen if we're going to have a new low. Credit spreads really didn't widen out that much. And to Steve's point, what's fascinating is the business uncertainty index hit higher than it was in March of 2020 during COVID, and that is a tremendously good contrarian signal. So I'm not, I still think the market probably ends in the low 6,000s for the year, but I think this is, we've seen this low of this correction.
So, you were on about a month ago when things were still, not quite as bad as they are now, and you were cautious, which was a change from your tone last year. So I appreciate your contrarian streak here, Andrew, although I wish you saw better things for the rest of the year. What gives you that caution? Is it growth? I mean, do you think we're going to have a slowdown? What do you think the Fed does?
Sure. Well, the key reason really is you're asking me about, or I spoke about the S&P 500 cap weighted. And I think the reality is that these really big mega cap tech stocks are spending a lot of money right now, and they haven't shown their returns. And I think it's going to weigh on the Mag 7, and it already has year to date. And that's going to pull the returns for the market down because there's such big weights in the market. So I think the 493, the rest of the market could do a lot better. I think there's other markets around the world. But for the S&P 500, I think this will continue to weigh on it. And, the overall, the index is a little expensive. So I could see a scenario where we get double-digit earnings growth, but not as good returns for the market. So the PE starts actually next year.
Steve, is there anything there that jumps out to you?
I'm sorry?
Well, I hear Andrew doing exactly what everybody I'm talking to is doing, which is trying to game out the probabilities on each side of the Fed's mandate, which is what's the probability of recession? What's the probability of there being higher inflation? And then there's kind of a third element to it, which is what is the thing that the Fed is going to have to address most acutely, okay? So when I asked Powell the question on Wednesday about the basically about those two risks and how the Fed would come down, he said, look, we look at each indicator and we say which is further from our mandate and which is the one that's in the outlook looks like it's going to end up being worse. I'm kind of squinting and trying to understand where Fed folks come down on those risks. And it sounds like to me, and I think this is what the market is taking from it, that the Fed is cool with the idea that medium and longer term inflation expectations are well anchored. So it doesn't see the, I don't know what you call it, the clear and present danger right now on the inflation side of the mandate. And that this sort of turns them over into saying, well, I'm generally more concerned about the growth side of the mandate. So the market hears that. Again, it's squinting and listening very carefully as well and saying, OK, if the worst outcome here is the growth outcome, then I can count on the Fed stepping in to alleviate that. So I have a better probability of the Fed coming in and cutting rates and helping out the economy and the stock market rather than being frozen here by higher inflation.